Hello, welcome to 2.1. This is the first in a series of 5 videos on theme 2. This first one is all about raising finance. So we've got internal and external finance, liability, and then business planning. These are supposed to be kind of recaps of these themes. Obviously, it goes without saying, in the space of 15-20 minutes, you can't recap in full depth an entire unit, and so that's not what these are aimed to be. They're supposed to be kind of used for revision, used for recaps of the kind of the general gist, and obviously then you would supplement this with your own study. In the description of this video, there will be a bunch of links to some resources that are going to be able to help you, including links to the other themes versions of these videos as well. So let's get started. 2.1.1 and 2.1.2 are very closely linked, of course, internal and external finance. They're all about the sources of finance available to a business. I actually teach these together. So if we start with our internal finance is the finance that comes from within the business. And there are a couple of sources that businesses will use when gaining kind of internal finance. The first of which is, and probably the most important for a small business, is the owner's own funds. So quite often with a small business, the owner's going to have to put in some money of their own, and in fact, a lot of new businesses that started from the ground up are funded this way. The key, obviously, with this is it doesn't have to be paid back, although the owner is likely to want to take some money out of the business as well. It's probably going to be how they make their money. But there's no interest, of course. There's no sort of formal repayment schedule. Obviously, the downside here is you are limited in terms of how much money the owner has, and so there could be a limit in that sense. It might not be enough to start a business, but that's the first one, that's the main one, and that's going to be the case for any kind of small business. They're going to have to use some of this at least. Retained profit is the next one. This is only going to be possible for a business that actually makes a profit, and this is basically just our previous profits that have been reinvested into the company. And the idea is behind this, I mean, this is technically the owner's own money because any profit the business makes belongs to the owners. So if they make the decision to reinvest it, then it is technically the owner's own funds, but instead of it coming from their own pocket, it's coming from the money that the business has generated. The obvious benefit with this, again, is it doesn't have to be repaid, but the ideal would be that it kind of generates more money in the future. So you might reinvest your retained profit now, knowing that you'll be able to get more back potentially in the future. The third is to sell an asset, and there's issues with this one because if you sell an asset, if that asset was something that you need or that you use or is part of your production, then you are in some respects limiting your max capacity. But if you've got something that you own, a business has got something they own that they're maybe not getting full use out of, they might decide to sell that asset in order to put the funds towards something else. Alternatively, if a business is doing quite poorly or has a cash flow problem, they might sell something that they own, but maybe they need because the need for cash immediately is a more kind of important factor. So, for example, if you have a vehicle, you might sell the vehicle to raise some much needed cash. And then if you still need a vehicle, you could potentially rent or lease a vehicle instead. And so, yeah, that sale of assets is something that you would only ideally do if it's something you don't need anymore, but could be a really useful one in case of emergency. So those are the internal sources of finance. When it comes to external, there's a few different things to think about here. First of all, it's finance that comes from outside the business. I think that's probably quite self-explanatory. But the first thing is we've got to understand the sources of this external finance before we look at the methods of external finance. So there's a variety of different sources that you can get your external finance from. You've got banks, of course, family and friends, peer-to-peer lending, other businesses, crowdfunding, so raising money from donations from a wide range of people, quite often using websites like Kickstarter. That might involve some sort of, they'll pledge obviously a little bit of money to you. You might have to provide some sort of reward for them in return for that. And then business angels as well, so investors who are interested in kind of helping invest in businesses and helping them grow. And from these sources, you can get a variety of different methods of finance. And so there's loan capital. So, for example, a bank loan where you borrow a sum of money and then repay it over an agreed schedule. The obvious benefit is you can gain access to a huge amount of money, potentially, depending on what it is you need it for, and depending on whether the bank believes that you're trustworthy of paying it back. But you will have to pay it back, and you will have to pay it back with interest. Interest rates are covered in 2.5 when we look at the economy. So in the 2.5 video, if you're not sure what interest is, you'll be able to catch up on that there. There are also overdrafts, and an overdraft is a form of loan capital, but it's a really short-term source of finance. You don't really use this in the long term. An overdraft is where you are able to temporarily go into a negative bank balance. And so you might have a bank account that has an overdraft facility. For example, £1,000. What that allows you to do is spend up to minus £1,000. And you might have charges if you go into that overdraft. You have certainly repayment deadlines. You have to pay off a certain amount per month. But if you're in a bit of a bind in a short-term situation, you could use your overdraft to gain access to some cash. But the key thing is you want to make sure you pay this back pretty quickly, because overdraft have usually quite high interest rates and sometimes carry charges as well, and will affect your credit rating. So loan capital, there's two options there. One's a bit more sort of medium to long term. The other one's very much a short-term solution. We have share capital, selling a share of the business. So you would sell potentially a percentage of the ownership of the business in exchange for investment. The benefit of this is you don't have to repay it back in terms of a regular scheduled repayment. The new investors, the new shareholders, would get a percentage of the dividends. They'd get a percentage of the profits back instead, and that would be their justification. Of course, they could also at a later date sell their share and maybe make a profit on that as well. Venture capital, similar to share capital, but this one is a little bit more risk-reward based. So an investor, a venture capitalist, is one who sees potential for profit within an organization. However, it might be quite a high risk compared to maybe just buying into a friend or family's business. And so they will invest with the intention of making a profit. And maybe that's going to be a short-term situation. Maybe that could be 6 months. Maybe that could be a year. We've got leasing, which is where we rent something instead of buying it. I mentioned leasing briefly when I said about the sale of assets. If we sold an asset, but we still needed to use that asset or a similar asset, we could potentially lease it. And the idea is, rather than one lump sum of a big cash outflow, it's kind of a source of finance, because they're sort of, although you never see the money, they're lending you the money you owe them over the next, however long it is, 2-3 years, it could be potentially longer. We also have trade credit. Trade credit is where you are able to access kind of a buy now, pay later facility. So a supplier, for example, might offer trade credit, and that's actually incredibly common with business to business transactions. So they might say, for example, you can receive the goods now or the supplies now, but pay within 30 days, 45 days, or what have you. You might offer credit to your customers as well. And so when you think about cash flow, one potential thing to think about is making sure that you are going to receive the cash from your customers before you have to pay your suppliers. So trade credit can be used in both senses, but in this sense, we're talking about this as a source of finance for the business. And so trade credit is about the business being able to get supplies and pay for them after a period of time. Often this is not going to have any interest in it. More often than not, it's going to be an interest-free agreement. It's just kind of the way things are paid for. And it allows you as a business to get the supplies and then hopefully turn them into revenue and generate cash flow before you have to pay your cash outflows. And then finally, we've got grants as well. So a grant is a non-repayable sum of money from a government, could be from an organization, mostly are from governments. The idea here is a grant might be available to someone who's maybe meets certain criteria or is providing a certain good or service. You might be able to get a grant for certain things. That covers our internal and external finance. The next topic is liability. Liability's been mentioned already in these videos in theme 1 when we talked about forms of business 1.5.4, because when we talk about liability, we're talking about limited liability and unlimited liability, which are mentioned in terms of our incorporated and unincorporated businesses. So let's just go through those differences again. Limited liability is where where the responsibility for debts is limited to the company. So the term liability is effectively legal responsibility, and so the legal responsibility for these debts is limited liability, you get it, to the company's assets. And so if there are debts that exceed the value of the company will have to sell all of its assets and potentially then, of course, be bankrupt, but that will be the end of it. The personal assets of the owners will be protected. So this is our limited incorporated companies, our LTDs, our private limited companies, and our PLCs, our public limited companies. Unlimited liability is where the responsibility for debts is not limited to the company's assets, and therefore personal assets are at risk. And these are our unincorporated companies, our sole traders, and our partnerships. So the first distinction in this topic is to know the difference between limited and unlimited liability. The second is to make sure you're aware of which sources of finance are suitable for different liability businesses. So for example, a limited liability company can raise share capital. Because they're an incorporated company, you can do this. It's obviously easier for a PLC because they're going to be selling their shares publicly. Whereas a unincorporated business, a sole trader or partnership, they can't sell shares. because there is no legal separation from the organization to the owners. In terms of the sole traders and partnerships, they can't sell shares. They're likely to rely on owners' funds. And actually, technically, and it can get quite complicated, but technically, owners' funds don't exist for limited companies, because if an owner was putting more money into the business, they would do that through an issue of shares. So it would technically be share capital they were raising. But a sole trader or partnership, they're quite likely to heavily rely on owners' funds. There are other sources of finance that are available for both, of course, but these are the kind of main distinctions in terms of what is certainly only available for certain types of business with certain liability. The last topic in this unit is 2.1.4 planning, and there's two parts to planning. And actually, I think you'd think about the first one, which is a business plan, and given the topic is called planning, naturally you would think business plans are probably the biggest part of this, but then they're not really. The biggest part of this is actually the second half of this. A business plan is the document that a business creates. An entrepreneur will create one when setting up a business, and it will set out the aims and objectives. It'll set out what the business wants to achieve, and it will start to give an idea of how a business is going to achieve that. So there'll be a marketing plan, there'll be an operations plan. You're demonstrating ultimately, potentially to yourself in terms of organization, but to investors and to potential employees, what it is your business is looking to achieve and how you're going to do it. And so it's really, really helpful in terms of accessing some of those sources of finance. For example, a bank loan, for example, venture capitalists, business angels, they may wish to see a business plan in order to make sure that they have confidence that the investment will repay what they put in. Part of the business plan will also be the cash flow forecast. And the cash flow forecast is a financial table. There's plenty of financial tables in Theme 2. This is the first of which. It is a forecast of the cash inflows and outflows over a period of time. And one thing that's really important is, and we'll talk about this as we go through this unit, is the difference between cash and profit. We're not talking about profit here. We're talking about when cash, as in immediate money, comes into and leaves a business's bank account. So this is more like kind of a financial statement of like a bank statement. It looks something like this. So in this one, we've got January, February. We've got cash inflows, outflows. We've got net cash flow, opening balance, and closing balance. So you could argue that this is basically like a bank statement for the months of January and February. We can do some calculations here. I'll talk through those as we go through some example figures. But you might see a table, it wouldn't necessarily look like this, but it would be in this order. Instead of saying cash inflows, it might list examples of cash inflows. So for example, it could be cash sales, it could be a bank loan, it could be owner's personal funds, what have you. Anything that comes into the business would go in there. And then your outflows could be all sorts of things. It could be the running costs of a business. But the key thing is the money will be when the money leaves the bank account. So for example, if in January we made £5,000 of credit sales, which we didn't receive until the following month, they wouldn't appear in January. They would appear in the month where that cash joined the business, so potentially February. So let's have a look at some example figures here. Let's start with an opening balance. Let's assume that we have an opening balance of 100 at the start of January. And then we've got cash inflows of £250. We've got cash outflows of £300. So we have more out than we have in. So our net cash flow would be minus 50. And you can see on a financial statement, you could see a minus or you could see brackets. It means the same thing. What that means is the first calculation here is net cash flow, which is cash inflows minus cash outflows. So 250 minus 300 is minus 50. And then the second calculation is to work out our closing balance. Well, if we started with £100 and our net cash flow is negative 50, then our closing balance is going to be 50. And the reason for that is we've done the calculation opening balance plus net cash flow. Now, in this instance, we are plussing a minus figure. So that means our closing balance is obviously going to be 50. The second month, February, the first bit of information we need is to know what our opening balance is. We started with our opening balance for January. We're going to do the same with February. If our closing balance in January was 50, then we're obviously going to start February with 50. So our opening balance is unless it's given to us, like for example, in the first month, they might give you an opening balance. After that, it's going to be the previous month's closing balance. And then let's do the same figures again. So we have a 400 cash inflow. We have a 300 cash outflow. So in this month, our cash flow is better. Our cash flow would be 100. If our opening balance was 50 and we've got a net cash flow of 100, 50 plus 100 is 150. So that covers our cash flow forecast. So the most important thing there is making sure you're aware of the calculations, making sure you're aware of the concepts, making sure you're starting to get an idea of what cash really, really means. It's really important that you understand the difference between cash and cash inflow and revenue. For example, there are plenty of revenues that aren't cash. There are plenty of examples of cash inflows that aren't revenue. Hopefully that makes a lot of sense. Hopefully you found that fairly useful. As mentioned, of course, at the start of the video, there are a bunch of resources in the description. If you have any questions about any of these topics, please pop them into the comments, and you'll see me and hear me. Well, you won't see me. I don't put my face in these videos. No one wants to see that. You'll hear me in the 2.2 video as well. See you next time.